Hello, welcome to Accounting Hub. I'm Professor George Scarpin, PhD in Accounting, and our topic today is franchise, especially about revenue recognition on franchises. So, what is the issue here? If we go to the 5 steps to recognizing revenue, the last one is about time. When or as we recognize revenue, when or as each performance obligation is satisfied. And a franchise, what do we have? In a franchise arrangement, a franchisor grants to the franchisee the right to sell the franchisor's products and use its name for a specified time period. Franchise often include a license to use intellectual property. By the way, we also have a video about license, and the video is in our video description, as well as initial sales of product and service transferred at the start of the franchise, as well as ongoing sales over the life of the franchise. Franchisor must evaluate each part of the franchise agreement to identify the performance obligation, especially the initial agreement, because over the life, usually they charge a percentage of revenue. So it will be just like any other revenue. So no big deal. But the initial agreement, there is an issue. And what is it? Let's go to our Excel file. And remember, our Excel files are free, and the link to download them is in our video description. So here, Scarpin Corporation sells Scarp Shops franchise. Scarpin charges franchisee an initial fee in exchange for A. The exclusive right to operate the only Scarp shop in a particular area for 10 years. 2. The equipment necessary to distribute and repair Scarpin products. And 3. Training service to be provided over a 4-year period. Similar equipment and training can be purchased elsewhere. So here, the initial fee is $5 million. The right, and then this $5 million is $3 million, the right to operate the franchise. $1.5 million is the equipment, and $500,000 the training. So here, the right to operate a Scarp shop, debit cash, credit deferred revenue, because it is over 10 years, so it is not a revenue yet. So $3 million. And here we have a revenue because equipment can be purchased elsewhere, so we are actually selling them the equipment. So it is not on the right to operate because they could purchase this equipment elsewhere. So cash and sales revenue, 1.5 million, and then the cost of goods sold for this equipment, etc. And the training, the same. So it's not over 10 years because they can purchase this training elsewhere. So cash also deferred revenue because the training service should be provided over a 4-year period. So it's deferred revenue again. And okay, this first revenue is already recognized. So the equipment, we are good. However, what about the right to operate a Scarp shop? Deferred revenue, license revenue, or any other name, 1/10 of the right to operate. So 1/10, $300,000. So here is the second revenue. So we will be doing this journal entry over the next 10 years, and here we are working on yearly basis, so 10 journal entries, and our deferred revenue will go to nothing. And the second deferred revenue, training for years, deferred revenue, and service revenue or training revenue here. So why 125 over 4 years divided by 4. So the total divided by 4, 125. So here, if we go back to our 5 steps, we have 3 performance obligations, and then on 3 different times. See how interesting it is? one arrangement, three performance, three different revenue recognitions. And so imagine the notes of this company on revenue recognition. It is huge. Okay, guys, that's it. Thank you so much. Questions or comments, leave them here or email me at jscarpin@gmail.com. Have a very nice day and God bless you.